In 2025, investors put 5.2 billion into build-to-rent in the UK. That is the highest amount ever recorded. At the same time, the number of new build-to-rent developments that actually started construction in London fell by 93% compared to 2022. 23 out of 32 London boroughs did not start a single new build-to-rent home last year. Not one. This video is about why that gap exists, why serious money is still coming in, and who could actually profit from it over the next 5 years. The gap between money going in and buildings coming out of the ground is real, and it is not closing fast. Investors are in. After a year of uncertainty, the rules around planning and tenancies have settled. But the schemes actually getting built in London are fewer, slower, and more carefully selected than at any point in the last 10 years. There is one way to think about build-to-rent that changes how you read all of this. So, build-to-rent is not a block of flats that happens to be rented. It is a proper business model. So, the building is designed from day one to be managed and let for 10, 15, 20 years. And that changes how you choose the site, how you design it, what you spend money on, and how the numbers actually work. I am Francesco Fasanella, co-founder of Habitat Investments and Habitat Living. We work on rental assets, advisory, development, management. And here is how I read the market right now. So why the money is here and why London is the center. A quick definition first. Build to rent is housing built specifically to be rented out long-term and professionally managed. So that's something completely different from a converted for sale flat. It is different from a situation of a landlord owning multiple properties. So it's purpose-built from day one, run, as we said, like a business. And there are two main types: multifamily, so large blocks in cities, shared facilities managed centrally, and single-family housing, houses for rent, usually in the suburbs, owned by large investors. Single-family housing has grown a lot. Roughly half of the build-to-rent investment in UK in 2025 went into this type, and that's the highest share ever. So why is so much money coming in? 4 reasons. 1. People cannot afford to buy. Even where mortgage rates have come down, the deposit is still the problem. People who expected to own a home 5 years ago are still renting, and renting for longer. 2. Smaller landlords are leaving the market. Tax changes, efficient energy regulations, and the new Renters' Rights Act have made being a private landlord a lot harder. But when they sell up, tenants do not disappear, they move somewhere else, and usually into professionally managed rental stock. 3. Large investors need stable, long-term income. I'm talking about pension funds, insurance companies, large investment vehicles. They all need income that comes in reliably year after year and roughly keeps up with inflation. And rental housing in a city where supply is tight does that. Commercial property has been noisier over the last 5 years, so many believe residential makes more sense as a long-term hold. 4. The rules have settled. The Planning and Infrastructure Bill, the Renters' Rights Act, and Scotland's Housing Act all passed in late 2025. There was a long period of uncertainty around tenancy reform and planning. That period is over, and now the framework is clear. All 4 of these hit hardest in London. The biggest gap between what homes cost and what people earn. The most visible exit of private landlords, the deepest pool of tenants, and the most consistent interest from large investors. One data point worth mentioning because people misread it. London rents fell in 2024, down 2.6% on average. In 2025, they went back up, plus 2.8%. So the market corrected and then stabilized. And for anyone looking at the numbers today, there is a meaningful shift. But London is not one market. South Kensington and Stratford are completely different places. When I talk about London built to rent, I am mostly looking at outer London with good transport links. Some examples: Stratford, Wembley, Canada Water, the Park Royal Corridor, parts of East and West London. And that is where the real opportunity sits right now. And now the delivery gap in London. And that is the part that usually matters for anyone trying to invest in this sector. London is where build to rent is most needed. It is also where the fewest new schemes are being built. we cannot ignore the numbers. New build-to-rent construction starts in London in 2025 were 93% lower than in 2022. A majority of London boroughs had 0 new starts in the whole of 2025. Across the UK, more build-to-rent homes are being finished than started, and that has been true for 8 quarters in a row. The number of schemes under construction is around 50,000 homes, roughly 15% fewer than a year ago. Why that? A few reasons, all real. Build costs are higher. Planning is slow and complicated. Developers often have to include affordable homes as part of getting planning permission. And when you run the math, the project often stops making sense. The gap between what an investor will pay for a finished building and what it costs to build it has been too tight. Some schemes that have permission just sit there. They do not get built. Read that the right way and the conclusion is simple. So the money is there, the demand is there, the rules are sorted. What is missing is operators who can actually deliver. Anyone who can close the gap will do well over the next 5 years. The shortage is not fixing itself. So where value is created and why doing it well matters. If build to rent is a business, where exactly do you make the money? From an investor's perspective, where exactly they can profit from build to rent? 4 things carry most of the way. First, the site. You are choosing a location for a 10-year hold, not a 12-month sales campaign. So you shouldn't ask just, can I rent it today? But it is more like, what does this market look like in 5 years? Will people still want to live here? Can the rents hold up if conditions soften? So a strong outer London location with reliable, long-term demand often works better than a prestigious central site with a very high entry price. Second, design for actual use. A lot of build-to-rent schemes look great on a brochure and start to show problems in year 3. Finishes that look good in photos do not always last 10 years of daily use. The shared spaces, gyms, lobbies, communal areas, have to be sized for how they will actually be used day to day, not for how they look in marketing materials. The service charge tenants pay need to be realistic from day one, and not underpriced now and then hiked later. Third, lease up. Lease up is the period between finishing the building and having it fully occupied. It carries its own cash flow risk. If your model assumes you fill the building in 6 months and it takes 9, that 3 months gap can wipe a full year of profit from the project once you factor in the cost of borrowing money. And operators who are generally good at this phase make much better returns. It is not just a matter of luck, but more like the process and the experience. And then fourth, management. Once the building is full, ongoing management is where returns either hold or quietly leak. A 2 to 3% drift in performance, slow repairs, tenants not being renewed, rents not being set at the right level, builds up over 5 years into a significantly lower sale price when you exit. And so small differences in management quality lead to large differences in what the building is worth. And there is a harder piece of context here too. Yield, which is the annual rent income as a percentage of what you paid for the building, has been falling in build to rent. In December 2025, prime central London at around 4.25%, Greater London around 4.5%, regional cities around 4.75%. Against interest rates, those margins are tight, and there is not much room for things to go wrong. Rent growth has also slowed down. UK rents outside London grew 8.6% in 2023, then 3.7% in 2024, then 2.2% in 2025. Healthy, but a very different environment from 2 years ago. Any financial model still using 2022-2023 growth assumptions will not hold up. Add to this higher build costs, financing costs, service charge inflation eating into income, and the new Rental Rights Act, which makes periodic tenancies the standard and gives tenants clearer rights to challenge rent increases. So you need to run a tight operation to make decent returns in this market. The easy years, where prices rising covered every mistake, are over. From here, it is about doing the job well. But where is the real opportunity right now? The big investors in UK build to rent are now operating at a different scale from before. In 2025, one of the largest publicly listed companies owning build-to-rent homes in the UK was taken private for around 1.1 billion. That sets a benchmark. Large investors are now looking at single deals worth hundreds of millions of pounds. They need size to make the numbers work efficiently. That means a large part of the genuine opportunity in London is in a different size bracket. Schemes that are too small for the largest investors, but too complex or too big for a private landlord. What are we talking about? Urban developments up to 20 to 40 homes in strong outer London locations. Mid-sized blocks of 80 to 120 homes, built, filled, then either held long-term or sold. Hybrid schemes where part of the building is sold to finance the rental portion. Portfolio deals where you bring together several assets with a clear strategy behind them. For a capital partner, meaning someone putting money into a deal rather than building it, the logic here is direct. If you find an operator who genuinely knows how to deliver and manage at this scale, you will often get better returns than competing for the largest institutional deals at very compressed prices. There is less competition, a bigger edge from doing the job well, different risk profile. The gap in yield between London and regional sites, as we said, about half a percentage point, is not just a number. It reflects how different these markets are to operate in, and who the eventual buyers are. Operators who understand how to work across both are not many, and the returns tend to follow them. The conversation around UK build-to-rent right now is happening exactly here. The money is looking for operators who can deliver, not for more plans on paper. So back to where we started, 5.2 billion invested in UK build-to-rent in 2025. London construction starts down 93% from 2022. Those two facts together describe the whole opportunity. Money in, but almost nothing being built. Whoever can deliver into that gap at real scale with proper operations will do very well over the next 5 years. And if you want to keep following how this market develops, there will be more to come on the channel.